Alright, welcome back to The Blueprint, everyone. The podcast where we decode the strategies behind building wealth. I'm Murph, and as always, I am here with the man who spends more time reading 10k reports than watching Netflix, Cooper.
It's a close competition some weeks, Murph. Good to be here.
Good to have you. Now, Cooper, you gave me the title for this week's episode, and I have to say, it's a bold one. A very, very bold one. Investing for Beginners: How I Make Millions Using Crypto, inspired from Mark Tilbury with stocks. That is a mouthful, and it's packed with so many buzzwords I think my microphone started overheating. Millions. Crypto. Mark Tilbury. What on earth connects those three things?
It does sound like a bit of a clickbait salad, doesn't it? But I promise, by the end of this conversation, it will all make perfect sense. It's a strategy I've been refining for years, and it's fundamentally about combining two very different worlds of investing: the old school common sense stability and the new school high growth mindset.
Okay, I'm intrigued. The audience is intrigued. But before we dive into how you're supposedly making millions and how our listeners can learn from it, we have to do the thing. The big, important, legally necessary thing.
Absolutely. Let's get it out of the way right at the top. Everything we're about to discuss today is for educational and entertainment purposes only. It is not financial advice. I am not your financial advisor. Murph is definitely not your financial advisor.
Hi, I have some great financial advice. Don't buy the extended warranty on a toaster. There. Done.
Shuckles. Okay, that's probably solid advice. But when it comes to investing your hard-earned money, you need to speak to a qualified and certified professional who can understand your individual circumstances, your goals, and your risk tolerance. We are just two guys on the internet having a conversation. Our goal is to give you ideas, frameworks, and a way to think about investing. What you do with that information is entirely your responsibility. Please do your own research.
Couldn't have said it better myself. Alright, disclaimer done. So, let's start with the first name in that title, Mark Tilbury. For anyone who doesn't know, he's a massive UK-based finance YouTuber, a self-made millionaire, famous for his simple, no-nonsense advice. He's the king of buy the S&P 500 and chill. So how does he fit into a strategy that has the word crypto in it? He seems like the polar opposite of the crypto world.
He is, and that's precisely why he's the foundation. You cannot build a skyscraper on a swamp, Murph. You need a solid bedrock of concrete. Mark Tilbury's philosophy asterisk is asterisk the bedrock. Before you even think about the sexy, high growth, make millions part of the strategy, you have to nail the fundamentals. And his fundamentals are flawless.
So what are they? Let's lay out the foundation for the beginners listening.
It's beautifully simple. Rule number 1, before you invest a single penny, you need to be financially stable. That means two things: pay off all your high interest debt and build an emergency fund.
The boring stuff. The stuff everyone wants to skip.
Exactly. People here are investing, and they want to jump straight to picking stocks. But if you have credit card debt at 22% interest, no investment on earth is going to reliably outperform that. Paying off that debt is a guaranteed 22% return on your money. It's the single best financial move you can make. It's not sexy, but it's the truth.
And the emergency fund?
3 to 6 months of essential living expenses. In cash. In a high-yield savings account where it's easily accessible. This isn't an investment, it's insurance. It's the money that stops you from having to sell your investments at the worst possible time because your car broke down or you lost your job. Without an emergency fund, you're not an investor, you're a gambler who can be forced to fold at any moment.
Okay, so get your house in order first. Debt-free, emergency fund in place. What's next in the Tilbury playbook?
Next is the core of your investment portfolio. And for 80 to 90% of your investment capital, you should be doing something incredibly boring. You should be buying the whole market.
And by the whole market, you mean an index fund? Like the S&P 500?
Exactly. An S&P 500 index fund gives you a tiny slice of the 500 largest companies in the United States. A global all-cap fund gives you a slice of thousands of companies all over the world. You're not betting on Apple or Google or Tesla. You're betting on the entire engine of global capitalism. You're betting that, over the long term, human ingenuity, innovation, and the desire to make a profit will continue to drive the economy forward.
And history is on your side with that bet. What's the average return?
Historically, the S&P 500 has returned about 10% per year on average over the long run. Some years it's up 30%, some years it's down 20%. But that 10% average is the powerful, wealth-building engine. If you just consistently put money into an S&P 500 index fund, and you do it for decades, you will almost certainly build significant wealth.
And this is where that other key concept comes in, right? Dollar cost averaging.
You've got it. Dollar cost averaging, or DCA, is the antidote to fear and greed. It just means investing a fixed amount of money at regular intervals, say $500 on the first of every month, regardless of what the market is doing.
So when the market is high, your $500 buys fewer shares. But when the market crashes and everyone is panicking,
your $500 buys way more shares. You're automatically buying low. It removes emotion from the equation. You're not trying to time the market, which is a fool's errand. You're just consistently accumulating assets over time. It's the slow, steady, tortoise-like approach that wins the race. This is the Mark Tilbury way. It's safe, it's proven, and it works. This is what you do with the vast majority of your money.
Okay, so that's the foundation. Pay off debt, build an emergency fund, and then put 80–90% of your investment money into a low-cost index fund every single month without fail. That's the bedrock. It's solid, it's sensible, and I have to be honest, Cooper, it doesn't sound like a way to make millions unless you're starting with millions or have a 50-year time horizon.
And that, Murph, is where the other part of the title comes in. That's where we take inspiration from the world of crypto.
Alright, here we go. This is the part I've been waiting for. How do you mix the slow and steady Mark Tilbury with the wild, volatile, min or bust world of cryptocurrency? You're not telling people to go buy Dogecoin with the rest of their money, are you?
Absolutely not. Let me be crystal clear, this strategy does not involve buying a single cryptocurrency. Not Bitcoin, not Ethereum, nothing. This is about taking the mindset of a successful, early-stage crypto investor, the smart ones, not the gamblers, and applying that mental model to the remaining 10–20% of your stock portfolio.
The speculative part of your portfolio.
Precisely. The part of your portfolio that you can afford to lose. This is your high-risk, high-reward allocation. The S&P 500 is your sturdy battleship, sailing reliably across the ocean. This 10% is your fleet of experimental speedboats searching for new lands. Some will sink, and you have to be okay with that. But one or two might just discover a whole new continent.
Okay, I like that analogy. So what is this crypto mindset? When I think of crypto investing, I think of insane volatility, meme coins, and a lot of hype.
And that's the surface level. But think about the smart people who made fortunes in crypto. What did they do? They didn't just throw money at a coin because its logo was a cute dog. The smart ones, the ones who invested in projects like Ethereum back in 2016 or 2017, did something different. They read the white paper.
The white paper, the technical document that explains what the project is, the problem it solves, the technology behind it. Most people just skip that.
And that's the point. They went deep. They didn't just look at the price chart. They tried to understand the fundamental utility of the project. They asked questions like, what problem does this solve? Is this a unique solution? Who is the team behind it? Are they credible? What is the total addressable market for this solution? Does this have the potential to disrupt an entire industry?
They were looking for the next foundational layer of the internet, the next big platform. They weren't just buying a currency, they were investing in a piece of technology.
Exactly. They were acting like venture capitalists. They were looking for the projects with the potential for 100x or even 1000x returns. And they understood that with that potential came immense risk. For every Ethereum, there were 1,000 failed projects that went to zero.
So you're saying you take that same venture capitalist, white paper reading mindset, and you apply it to the stock market?
That is the entire crux of the strategy. You take the 10–20% of your portfolio, and you hunt for the stock market's equivalent of a pre-boom Ethereum. You look for individual companies that have the potential for explosive, crypto-like growth.
So we're talking about growth stocks, but on steroids. You're not talking about buying Apple or Microsoft with this money. They're too big.
Correct. They are the established empires. They are fantastic companies, and they are the cornerstones of your S&P 500 index fund. But they are not going to grow 50x from here. It's just mathematically improbable given their current size. I'm looking for the companies that could become the next Apple or Microsoft. The smaller, more innovative, often misunderstood companies poised to ride a massive technological or social wave.
And how do you find them? The stock market is huge. There are thousands of companies. It seems overwhelming.
It is overwhelming if you don't have a framework. So, just like that early crypto investor, you start with the big picture. You don't start with a stock ticker. You start with a trend. A massive, undeniable, multi-decade macro trend.
Give me some examples.
Right now, the most obvious one is artificial intelligence. It's a seismic shift that will reconfigure entire industries. Another is the green energy transition, decarbonization, battery technology, grid modernization. You could also look at genomic sequencing and personalized medicine, the future of biotech. Or cybersecurity as our world becomes more and more digitized. Or the space economy. You identify these giant waves first.
So you become a bit of a futurist. You try to see where the world is going.
You have to. You're trying to invest in the future, not the present. Once you've identified a wave you believe in, say AI, you then start to drill down. You ask, okay, who are the companies that will benefit most from this wave? And you can break that down further.
How so?
Well, in the AI wave, you have different layers. You have the picks and shovels layer. During the gold rush, the people who made the most reliable fortunes weren't the prospectors, but the people selling the picks, shovels, and blue jeans. In the AI gold rush, who's selling the shovels?
That would be the chip makers. The companies designing and building the GPUs that power the AI models. Nvidia is the giant one, obviously.
Nvidia is the perfect example. If you had identified the AI trend early on, say 5 or 6 years ago, and realized that GPUs were the essential hardware, you would have looked at Nvidia. At the time, it was mostly seen as a gaming company. What if you did the white paper research if you read their investor reports, listened to their earnings calls, understood what their CEO Jensen Huang was talking about with data centers and accelerated computing, you would have seen the future they were building. You would have seen that the gaming GPUs were a Trojan horse for much, much larger data center business.
And the returns on that have been, well, crypto-like. It's gone up thousands of %.
Exactly. That's a home run. But there are other layers. Below the big chip designers, you have the companies that make the manufacturing equipment that the chip factories use. Companies like ASML, which has a monopoly on the extreme ultraviolet lithography machines needed to make the most advanced chips. That's another, even more niche pick and shovel play.
Okay, so you have the hardware layer. What else?
You have the platform and infrastructure layer. The cloud companies. Amazon's AWS, Microsoft's Azure, Google Cloud. They are renting out the computing power for other companies to build AI on top of. Then you have the application layer. These are the companies using AI to build specific products. This could be a software company that uses AI to revolutionize customer service, or a biotech company using AI to discover new drugs. This layer is often risky because there's more competition, but it also has huge potential.
So the process is find the macro trend, then map out the entire ecosystem of that trend, from the foundational hardware to the end-user applications.
Precisely. And now comes the hard part. The part that separates this from just gambling on tech stocks. You have to do the work. The read the white paper part.
Which for a publicly traded company isn't a white paper, it's their financial filings. The 10K, the 10Q.
Yes. The annual and quarterly reports. And I know, the moment I say read the 10K, people's eyes glaze over. They imagine a 200-page document full of accounting jargon and legal disclaimers. And it is. But you don't need to be an accountant to get immense value from it.
So what are you looking for? What's the secret decoder ring for a 10K?
You're looking for the story. You start with the business section. The company has to explain, in its own words, what it does. Who are its customers? What products does it sell? How does it make money? Then you look at the risk factors section. The company is legally obligated to tell you everything that could go wrong. It's a goldmine of information about their competition, regulatory hurdles, and dependencies.
Most people just see that as boilerplate legal text.
And it can be, but often there are gems in there. If a company says, we are highly dependent on a single supplier for a critical component, that's a huge red flag you need to investigate. If they say our industry is subject to rapid technological change, that tells you their competitive advantage might not last long.
Okay, so business section, risk factors, what else?
Then you look at the numbers. But you don't have to be a math genius. You're looking for simple trends. First, revenue. Is it growing? How fast? Is that growth accelerating or decelerating? Consistent, accelerating revenue growth is one of the most powerful signs of a healthy, in-demand business.
So you want to see the top line going up, and preferably going up faster each year?
Yes. Then you look at profitability. Are they making money? A lot of high-growth tech companies aren't profitable in their early years because they're reinvesting everything back into growth, and that's okay. But you want to see a path to profitability. Are their margins improving? Is their net loss shrinking as a percentage of revenue? If a company is doubling its revenue but tripling its losses every year with no end in sight, that's a problem.
What about the balance sheet? Debt is a big one.
A huge one. I look at the debt-to-equity ratio. How much debt does the company have compared to the value of the company owned by shareholders? I am very wary of companies with a mountain of debt. Debt makes you fragile. A company with no debt and a pile of cash can survive a downturn, can invest in R&D, can acquire competitors. A company with a lot of debt is beholden to its creditors. In a recession, debt can be a death sentence.
So you're looking for a company with a great story in a growing industry with accelerating revenue, a clear path to profitability, and a clean balance sheet.
And one more thing, Murph. Perhaps the most important thing. The management team.
The jockey riding the horse.
The best jockey in the world. In early stage, high growth investing, you are betting on the founders and the CEO almost as much as you are betting on the product. Is the founder still involved? Do they own a significant amount of stock? That's called skin in the game. If the CEO owns 15% of the company, their interests are aligned with yours. They want the stock price to go up just as much as you do.
And you can find that ownership information in the filings as well.
Yes. You also want to listen to them. Go on YouTube and watch interviews with the CEO. Listen to the quarterly earnings calls. Do they have a clear, compelling vision for the future? Can they articulate it well? Are they transparent and honest when things go wrong? Or do they make excuses and blame others? I want to invest in visionary owner-operator CEOs who are obsessed with their product and their mission. Think Steve Jobs at Apple, Jensen Huang at Nvidia, Elon Musk at Tesla. Love him or hate him, he is undeniably a driven, visionary leader with immense skin in the game.
So this is a huge amount of work. This isn't just buying a ticker symbol because you saw it on the news. This is becoming a temporary expert on a specific company.
It is. It's work. And that's why you can only do it for a small number of companies. You can't do this for 50 stocks. But for that 10 minutes, 20% of your portfolio, you can build a concentrated list of maybe 5 to 10 companies that you know inside and out. You understand their mission, their financials, their leadership, and their competitive advantage, their moat, as Warren Buffett calls it.
And you're saying that by doing this intense, focused research on a handful of potential high flyers, you can achieve crypto-like returns within the regulated, more transparent world of the stock market.
That's the goal. You are looking for asymmetrical bets. A stock can only go down 100% to zero, but it can go up 1,000%, 5,000% or more. By doing this deep research, you are trying to tilt the odds in your favor. You are reducing the risk of picking a dud that goes to zero, and increasing your chances of picking a winner that can deliver those massive returns and pull up the performance of your entire portfolio.
What about when you're wrong? Because you will be wrong. Even the best venture capitalists are wrong most of the time. Their entire model is based on 1 or 2 massive wins paying for all the losers.
An excellent and critical point. And the answer is twofold. First, this is why it's only 10 minutes 20% of your portfolio. Your battleship, the S&P 500 index fund, keeps chugging along no matter what. If one of your speedboats sinks, it's a small loss in the grand scheme of your total wealth. It won't capsize your entire financial future. You have to be psychologically prepared for some of these picks to lose 50%, 80%, or even go to zero.
And the second part?
You need an exit strategy. And you need to constantly reevaluate your thesis. When you first buy a stock, you should physically write down the reasons why you bought it. I am buying company X because they are a leader in the cybersecurity for small businesses. They are growing revenue at 40% a year. They have no debt and the founder CEO owns 20% of the company.
So you have a record of your original investment thesis.
Exactly. Then, every quarter, when they release their new earnings report, you review it. Is the thesis still intact? Is revenue still growing at a high rate? Did they take on a huge amount of debt? Did the founder just sell half their shares? If the fundamental reasons you bought the company are no longer true, you have to be disciplined enough to sell, even if it's at a loss.
And what about the opposite? What if the stock doubles or triples? The temptation to sell and lock in those profits must be huge.
It is. And this is where you have to differentiate between a change in price and a change in the business. If the stock has tripled, but the business is executing even better than you expected, the market opportunity is proving to be even larger, and your thesis is stronger than ever. Why would you sell? Selling your winners too early is one of the biggest mistakes an investor can make. You're cutting your flowers to water your weeds.
So you let your winners run, as long as the investment thesis remains intact.
You let them run. You can trim a position if it becomes an uncomfortably large part of your portfolio, say it grows to be more than 20% of your entire net worth. That's just prudent risk management. You might sell 10% or 20% of your position to rebalance. But you don't sell the whole thing just because the price went up. The goal of this strategy is to find those 1 or 2 companies that you can hold for 10 years as they go from a small player to a dominant force in a new industry. That's how you get the 100x returns. That's how the small, speculative part of your portfolio can generate millions of dollars in wealth over the long term.
Okay, this is all making a lot more sense now. It's not a get-rich-quick scheme. It's a get-rich-slowly scheme for 90% of your money combined with a very disciplined, research-intensive, get-rich-quicker scheme for the other 10%.
That's a perfect summary. The Mark Tilbury pod protects you from ruin. The crypto-inspired part gives you the potential for life-changing returns. They work together. One provides stability, the other provides upside.
Let's make this even more practical. Someone is listening to this right now. They're a beginner. They've paid off their credit cards, they have their emergency fund. They're ready. What is the very first step to putting this into action?
The first step is purely mechanical. You need to open a brokerage account. In the US, you have great options like Fidelity, Vanguard, Charles Schwab. In the UK, you might look at trading 212 or free trade. The key is to find one with low or no commissions and access to the funds and stocks you want to buy. Opening an account is usually a simple online process that takes less than 15 minutes.
And you'd recommend opening a specific type of account, right? Like a Roth IRA in the US or an ISA in the UK?
Absolutely. Before you even open a standard taxable brokerage account, you should max out your tax advantage accounts. A Roth IRA in the US lets your investments grow and be withdrawn in retirement completely tax-free. It is the most powerful wealth-building tool the average person has access to. In the UK, a stocks and shares ISA offers similar tax-free growth. Max these out first. It's free money from the government in the form of tax savings.
Okay, account is open, it's a tax advantage one. What's the first buy?
The first buy should be the boring one. Your S&P 500 or global index fund. Set up an automatic transfer and investment from your bank account for every month or every payday. Set it and forget it. Automate the bedrock of your portfolio. That's step 1.
And then for step 2, the fun part. The speedboat fleet.
For step 2, you don't buy anything. For at least a month, maybe longer.
All a classic Cooper move. The answer is patience.
The answer is always patience. You need to start building your circle of competence. Pick one of those macro trends we talked about: AI, biotech, whatever interests you most. You have to be genuinely interested or you won't do the work. And then just start reading. Read articles from the Wall Street Journal, Bloomberg, the Financial Times. Follow smart people in that industry on Twitter or LinkedIn. And start building a watch list.
A fantasy portfolio, essentially.
Exactly. In your brokerage account, you can create a list of stocks you want to follow. Pick 5 or 10 companies in the sector that seem interesting. Don't invest any real money yet. Just follow them. Read their latest news. Go to their investor relations website and download their latest investor presentation. It's like a simplified, marketing version of their 10K designed to be understood by normal people. It's a great starting point.
So you're paper trading. You watch these stocks, you pretend you bought them, and you see how you do. But more importantly, you're learning the rhythm of these companies.
You're learning the story. You'll start to understand who the main players are, what the key technologies are, and what drives their stock prices. After a few months of this, you'll have a much better feel for the industry. You'll have done the initial white paper reading. And only then, when you've identified a company that you feel you understand deeply and that checks all the boxes: great product, huge market, strong growth, solid financials, visionary leadership, do you make your first small investment.
And when you say small?
I mean small. If your speculative allocation is 10% of your portfolio and you want to own 10 individual stocks, then each position should only be 1% of your total portfolio. You build these positions slowly over time. You don't have to go all in on day one. You can buy a little bit, and then if the company continues to execute well and the thesis holds, you can add more on pullbacks.
So this whole process, from opening an account to having a fully built out speculative portfolio, could take a year or more.
It should. It absolutely should. Anyone promising you that you can do this in a weekend is selling you something. This isn't a race. This is a deliberate, methodical process of building a skill. Skill is learning how to analyze a business. Once you have that skill, you can apply it for the rest of your life.
So let's circle back to the original claim. How I make millions. This strategy, the 90/10 split, the deep research, has this genuinely resulted in millions for you?
It has over a period of more than a decade. But the millions didn't come from one single lucky pick. They came from the combination. The vast majority of my net worth is still in boring, low-cost index funds. That's the engine that has been steadily compounding for years and years, turning my savings into a significant sum. That's a multi-million-dollar foundation. The individual stock picks, the crypto-inspired part, have acted as a massive accelerant.
The turbocharger on the engine.
A perfect analogy. I've had some spectacular wins. Companies I bought 10 years ago that are up 40 or 50 times what I paid for them. Those were the ones where I identified a trend early, did the research, and had the conviction to hold on through brutal volatility. I also had my fair share of losers. Companies that I thought were the next big thing that just fizzled out and I had to sell for an 80% loss.
But the wins more than made up for the losses.
by an order of magnitude. And that's the key. One Forex winner pays for a whole portfolio of losers and then some. But I could only take those risks, I could only stomach the volatility and the losses, because I knew my financial future was secured by the boring 90%. I wasn't betting the farm. I was only betting with my speedboat money. That's the secret. The psychological freedom to make bold, long-term bets comes from having a foundation of absolute safety.
So the title, while clickbaity, is actually true. The millions come from the combination. The stability of Mark Tilbury's approach allows you to successfully implement the high-growth, crypto-style research method.
You've got it. That's the entire system. One part common sense, one part venture capital. Bedrock and speedboats. It's a barbell strategy. You have extreme safety on one end and extreme risk on the other, with very little in the middle.
What do you think is the biggest mistake a beginner will make when they hear this?
They'll ignore the first half of the conversation and jump straight to the second. They'll forget about the emergency fund, the debt, and the 90% in index funds. They'll take 100% of their money and start trying to find the next Nvidia. And they will, almost certainly, lose a lot of it. The boring stuff isn't just a suggestion, it is a non-negotiable prerequisite. You cannot have the upside without the safety net. Period.
It's like trying to be a tightrope walker without a safety net. You might make it across once, but the career is going to be short.
Exactly. The net is what allows you to get back up and try again when you fall. And in this kind of investing, you will fall. The goal is not to never fall, it's to make sure the falls don't kill you and that the successful cross and pay for everything.
Cooper, this has been an incredible breakdown. We've gone from a confusing clickbait title to a really robust, logical and actionable investment philosophy. Let's summarize the key takeaways for everyone one last time.
Absolutely. Step 0. This is not financial advice. Do your own research and speak to a professional. Step 1. Build your financial foundation. Pay off high-interest debt and build a 3-6-month emergency fund. Step 2. For the core of your portfolio, 80-90% of your capital, invest consistently into a low-cost, broad-market index fund like the S&P 500. Automate this. Set it and forget it. This is your path to wealth. Step 3. For the small, speculative portion of your portfolio, the final 10-20%, adopt a venture capitalist mindset inspired by early crypto investors.
And that mindset involves identifying huge, multi-decade macro trends, mapping out the ecosystem of that trend, and then doing deep, fundamental research, the white paper reading on a small number of individual companies.
Looking for a visionary management team with skin in the game, a strong balance sheet with little debt, a huge market to grow into, and a product that people love. And finally, you write down your thesis, you monitor it, you cut your losers if the thesis breaks, and you let your winners run as long as the story remains intact.
And above all, be patient. This is a marathon, not a sprint.
That's the whole blueprint. It's simple, but it's not easy. It takes discipline, patience, and a willingness to do the work that others won't. But if you follow it, you put the odds of building serious, life-changing wealth firmly in your favor.
Incredible stuff, Cooper. I think you've just given our listeners a masterclass. That's all the time we have for today. Thank you so much for breaking that all down.
My pleasure, Murph. Always a great conversation.
And a huge thank you to everyone listening to The Blueprint. If you found this valuable, do us a favor and hit that like button, subscribe so you don't miss our next episode, and maybe share this with a friend who's just starting their own investing journey. Until next time, keep building.